So I appreciate everybody taking some time today. We have Jordan Kuhlengel on the webinar as well. He's a partner in the firm, runs our small business, high net worth side of our tax practice and consulting practice. So we're going to talk about things today that don't necessarily only apply to the financial advisor. It kind of crosses over. So we have him. We're happy that he took the time to join the webinar. And then Catherine Cruzy, she's going to be our moderator. If you have questions, need anything, send the chat to her. I guess she's not going to be on video like Jordan and I, but she is there, and she'll be able to get questions answered as we go. High-level agenda, we're going to talk about charitable giving, both at just how does it work with your taxes, and then various different planning opportunities and ways you can plan your charitable giving, whether in the future or in or current year or in the future. We're going to talk about family limited partnerships, what they are, why they're useful, and in various scenarios that you might want to think about them for you or your clients. We're going to talk about potential tax law changes. There hasn't been many things that actually passed in the past, call it 6 to 12 months. Things are on the table potentially for this fall, so we'll talk about what we see there, and then some planning opportunities on the what can you do now slide. Jordan, any thoughts before we get rolling?
No, I think we're ready to go.
Sounds good. Sounds good. Let's see. Oh, real quick, our team, we got our Jones team, me, Dakota, and Brandon. Client service team, Ellen, Catherine, Nicole. If you ever call into the office and need anything, you're going to talk to one of them first, usually. Then obviously talking FA taxes, you're going to get me, Brandon, or Dakota. And on the small business side, we have Cruzy, Jordan, and their team as well. Always want to just put names with faces for people that might not know everybody on our team. Backwards. All right, charitable giving. So at a high level, there's really 3 different ways you can give to charity and deduct them on your personal taxes. Give them cash. It's normally a 60% deduction, which means you can deduct up to 60% of your income. Not you only deduct 60% of the charitable contribution. You can deduct up to 60% of your income. That changed for a couple years with the coronavirus, various tax law changes, where that became 100% of your income, then 50 in the past. Now it's 60. So if you make $1 million, you give away $750,000. You are only deducting $600,000 of that, or 60% of the $1 million, and the rest carries forward to future years. It's a 5-year carry forward, I believe. If you donate appreciated securities, long-term capital gain securities, not short-term. You donate a share of Apple that you bought in 1982 and has a giant capital gain. Donate that entire security to charity, and you can deduct up to 30% of your income for that type of donation. So it's not 60, still good. You can do up to 30. So in my $1 million example, you could deduct up to 300,000 of appreciated security donations. You never pick up the capital gain. So it's a wonderful way to really, you can think about it, just reset your basis in the stock. If you want to give a charity $20,000 and you have a $20,000 appreciated security, give them the stock or mutual fund or whatever it is. Use the 20 grand that you were going to give to them and rebuy the stock if you really want that. And it resets your basis without picking up the capital gains. It's a beautiful way, beautiful and good tax planning there. And then other non-cash.
And then on that part, Blake, some people may be worried. I don't want to pass on my tax burden to a not-for-profit. I don't want them to have to pay that for me. This happens every day, and also you won't be. They won't pay taxes on it. They'll get your security and almost certainly immediately turn around, probably that same day, and then sell it and then get the cash, and they don't pay any income taxes on it either.
The other one is other non-cash, clothing, furniture, whatever it is. It's also limited to 30% of your income. Don't think I've ever seen anybody get to 30% of their income on that one, but again, it's not that you deduct 30% of the donation, it's that you deduct up to 30% of your income.
Yep. So on the cash piece, one common misconception that I always hear from clients is, well, what if I write a check? That's cash, considered a cash donation. And then on the other non-cash, I would say the normal skew that I see is maybe people overvalue things, or they don't get something written on a Goodwill receipt, so they don't value it at all. I would certainly try deducting. There's websites that are out there that can help you determine a fair value for what you're donating. But I would at least try something. It's a pretty low audit risk overall. And also, if you do get audited, it's almost certainly one of the things that they will look at, and then they will automatically adjust it for you. So it's not something I would be overly concerned about.
Definitely, and unless you're giving away your entire house because you're downsizing or something like that, it's rare that it's a big enough number to really worry. There's definite websites online that kind of help you value whatever it is. I would use those, like Jordan said. It's either zero, they don't give us anything, a client doesn't give us anything, or it's crazy low, like $3, or it's crazy high. I feel like it's rarely in the middle where it should be. And it's something it takes 5-10 minutes to get on that website, and most people are in a pretty substantial tax bracket. It's worthwhile to make sure you're getting good stuff there.
Yep.
All right. So a few things that we're going to go through, just different options you have other than just giving the money to charity. That's obviously option one. That's what most people do. With the standard deduction, the way it's changed in the past 4 or 5 years, it really has increased. So it made a lot of people that were used to itemizing their deductions and therefore deducting their mortgage interest and charitable contributions go to where they're not itemizing their deductions, or if they are, it's just by a little bit. So if you look at bunching your charitable contributions into 1 year, let's say you normally give your church $4,000 or $5,000 a year, and then you give other charities another $4,000 or $5,000. Somewhere between $8,000 and $10,000 a year is what you give. If you, instead of doing that every year, depending on your tax situation, you could potentially get zero tax benefit for those donations. If you said, well, I'm going to bunch them together and take 22, 23, and 24's charitable contributions, and instead of giving $8,000 to $10,000 a year, I'm going to do 24 to 30,000 all in 1 year, and then zero in 23 and 24. It could be that makes you deduct the vast majority of those charitable contributions. Depending on your tax bracket, it could save you $4,000 or $5,000 easily in my example. Very easy to do. You just have to have a little bit of planning. We'll go through a few other ones, might be because the number one thing people would say, hey, maybe I don't have $30,000 to just give, or do I really want the charity to get it all up front? Are they going to expect more, or their budget's going to change? There's definite other stuff there, but on a pure tax basis, bunching could make sense. What's up, Jordan?
Yeah, on the bunching piece, I just wanted to be very clear. This isn't I've gathered receipts over the last 5 years of all the donations I've done, and I finally turned them into Blake. This is I, in reality, donate everything in 1 year rather than spread out over those 5 years.
Great point. Great point. That is true. So the next option would be a donor-advised fund. This is, in essence, bunching without having to choose exactly what charity gets what dollar right away. So let's use our same example. We're going to, instead of doing 10 for 3 years, we're going to do $30,000 in 1 year. Maybe that's an appreciated stock. Maybe it's just cash. Either way, it's fine. You can create a donor-advised fund. It's, in essence, an investment account. Put the $30,000 in there in 2022. You fully deduct the $30,000 in this year, and then you give it away to charities as you wish. You can't take it back to you. You can't give it to, let's say, a homeless person on the side of the street, even though that's a charity. You give it to a real charity, but you don't have to do it all in 22, 3, or 4. It can be however. There's no real required distributions right now on a donor-advised fund. It can help solve the issue of, I just don't know who's going to get it yet, or is it, do I want the charity to get all the money right away, or kind of as they go for budgeting purposes?
Yeah, I would say the only potential downfall to a donor-advised fund, and all the benefits that Blake talked about are definitely there. If you have maybe a small local charity, it's possible that you'll have trouble donating to them versus a large national charity. If you're planning on, hey, I'm trying to decide between a humane society and the Red Cross, and I just don't know and I want more time, yeah, put it in a donor-advised fund, and then you'll have no trouble going forward after that.
There could also be minimums on because you're usually working with, Edward Jones or JP Morgan, a big charitable fund. If you say send $25 to the local humane society, there might be a minimum there, $100, $500, something like that as well. Option 3, fairly rare, but in theory, you can start your own 501c3. Jordan has worked with a lot of clients, probably a half dozen over the last year or two, starting their own 501c3. You really need a passion project for that. I've grown up with horses and horse therapy with kids. I've seen it work. Me and my spouse want to set up we already have a horse farm. Let's go ahead and just make it to where we get local donations and really make it a real thing. Great, could totally work. Or I'm going to travel the world and go to different orphanages in Africa and take care of kids there. Great, that's a thing. If it's not going to be, I was talking to a client the other day. They have a competitor who is just setting up. These are private foundations they're setting up, and they're putting contributions in there with no real charitable intent. And then 10, 15, 20 years later, they're then running the charity and getting a W-2 for running the charity. Purely, I would call that tax fraud. We're not trying to go down that road, clearly. But if you really have a passion and you just don't have there's just not that charity around you, it could make sense to start your own. We can help you through applying with the IRS, getting your articles of organization with the attorney, getting the book set up so you're running it like a real charity, having the letters sent out, all that stuff we can help you with. So definitely give us a call on that. Any thoughts, Jordan, on that one?
No, I think you kind of hit the nail on the head of it's you wanting to develop something to help other people. If something's already in place, absolutely fund it. Starting a 501c3 is not as easy as registering an LLC. There's more restrictions in place. There's a whole process to go through the IRS. So really, whenever Blake's talking about needing that passion project, is absolutely correct. This isn't something that you go into kind of with one foot, kind of dipping into the water. You kind of have to jump both feet in on it.
100%. The next one, private foundation, similar to your own 501c3, only that is that a 501c7, Jordan, or did I just make that up? Is it a separate?
I think it's still considered a 501c3.
501c3 is just a type of 501c3. This is in essence a charity that is almost fully funded by one person or family. I think it's over 50%. If all of them come from one person, even if there's a lot of other donations, which in most cases what we've seen, it is with one person funding the entire thing. It's just different than a charity, than a public charity, private foundation. A little more scrutiny there, and it's what we've seen. It's rare that the private foundation has, like we talked about with your own 501c3, the passion project. This is more legacy. I want to place $2, $3, $4 million in this foundation. We're going to have our board meetings, have our specific charities we support, get the family members involved, and it's going to go for the next 50 years. Usually that's when a private foundation could make sense. The Kuhlengel Family Foundation, I'm sure, is in existence and runs Oakville. So if you want that to be a part of the thing, that's where that would come in. More and more, I've kind of found the donor advised fund can accomplish your same goals much cheaper, less pitfalls and scrutiny from the IRS. But again, if you have that true legacy goal with your family, private foundation could work. But there's definite big time upfront costs on that, and just ongoing administrative costs that just aren't there as much with the donor advised fund.
And there's some additional administrative complexities to a private foundation. It's still considered, a charity. I, as an outsider, could donate to the Blake Will Private Foundation. I would still receive a tax deduction. It's a little bit different percentages, but normally those don't come into play for most people, to be honest. And those private foundations can still be operational. So let's say you want to do, Blake's talking about horse therapy. If you want to do that, but you also know, I'm pretty much going to fund this myself, that's okay. It's still something you can do. So really, it's a decision between a public charity and a private foundation. Both have their kind of positives and negatives, but both of them are good things.
Sure. The last one would be the charitable lead trust. There's other charitable options here, but the 5 we're highlighting. The last one is the charitable lead trust. I always like to think of this as the opposite of a donor advised fund, even though it's kind of the same thing. Donor advised fund, remember, you place the asset in the fund, you get a donation deduction for the value of the asset, and it's in there. Charitable lead trust, you're also placing various securities or mutual funds into, in this case, a trust, but some sort of investment account fund. And then you are, per the trust agreement, saying that you'll give away X dollars or X percent of assets over the next however many years. So you get a deduction for the present value of the string of the annuity of donations in essence. So if you're going to give away 10 grand a year for 10 years, 100,000 bucks, that gets discounted back. The present value might be 80 grand, let's say, or 85,000. So you still get a solid donation deduction up front, but it's more about what you're going to give over the next however many years. The 2 other unique parts of this is, well, if you're giving away, let's say 5% of assets, and that equates to 10 grand, I believe that would be, is that $200,000, Jordan, you'd have to put in, I believe is what the math would be. So you put in 200 grand, and then you're giving away $10,000 a year. When that 200 at the end of 10 years, in my example, and it's, made up example, you can make it however long, whatever percentages you want to do. At the end of 10 years, whatever's left, if the 200,000 grew by more than 5%, for example, there's more than 200,000 left, that comes back to you. Versus a donor advised fund, it's in there, gone, to the charity at some point. So charitable lead trust, all of these, usually we see them used in conjunction with something else. If it's a long-range charitable goal, great. If it's, I want to do a giant Roth conversion and offset some of the tax now, or I sold my business and I have a 1 or 2 year pop in income, so I want to accelerate some deduction. Great, charitable lead trust is a great option for you there. Usually they're in conjunction with something. It's not, well, I usually give away 20 grand a year. Now let's do a charitable lead trust and suck it all in. Probably not worthwhile. It needs to be in conjunction with an outlier thing, usually. All right, Catherine, do we have any questions or anything, or should we keep rolling? We spent a little more time on charity, I think, than normal.
We do actually have a quick question, Blake, and this kind of goes back to individual giving. But we did have somebody ask, what are the best methods for tracking my donations throughout the year? Is there any software
I would say
clients could use?
Yes, I would say there's a couple. There's definitely more than the 2 I'm going to mention. But we like itsdeductible.com the most. Very easy to use. It's a TurboTax product. You can do your non-cash donations there. You can do your cash donations. It remembers your charities from year to year. I have an app on my phone. Very easy to use. Also, if you're already using our business expense manager for your business expenses, there's and that is more, it doesn't have to be business expenses for that. That is more just for you to track things with. So feel free to put your charitables in that as well.
And then just make sure to also hold on to the actual donation letter itself from the charity, simply showing that money came out of your account and even went to a not-for-profit is not technically enough with the IRS. I don't know that they would actually overturn it, but they would certainly have the ability to if they chose to.
Great, thank you.
All right, so switching gears to family limited partnerships, or FLPs. The goal on these next couple slides is to explain it at a very high level. There is a lot of stuff that goes into whether this is the correct entity for you. Having a planning session with Jordan would be a great way to determine what is the right structure for me. Is it family partnership where I should go? Should I just keep an LLC? Should I create a public charity or private foundation? Should I set up a trust, revocable or irrevocable? All kinds of options there. We're going to focus on FLPs today and just at a high level. So starting with when are they worthwhile? So the point of them would be keep assets in the family while maintaining control and ease of use after death. So if Jordan dies and he owns 2,000 acres of row crop farmland, and he has 16 kids who now each have their own 4 kids, if it just goes to them and it's like everybody owns a piece of this thing, could be a complete pain and disaster. And instead of the fun family farm that everybody grew up on, it's now everybody hates each other. Let's just say that's an option. Put it all in an FLP, everybody might still own their interest in the FLP, but a certain person or two or entity might be the general partner and control the asset after Jordan passes away. Also, you could gift assets out of your estate while maintaining control. So right now we have a high estate tax exemption in the $12 million range a person. If you gift the farmland to your son, he owns the farmland. If you put it in a family partnership and gift an interest in the partnership or a LP unit, still owns the LP unit, and therefore the value of that went to him, but the grantor, the parent, still has control of the partnership. Third reason, getting other family members involved in the decision-making process. At some point, Jordan's 16 kids are going to need to know how to run the farm. Get them going now. You know, this is a family deal. This is how we do it. And the last one would be income tax averaging. A lot of times we're wrapping up 3 or 4 family partnerships this week. And one of the reasons is the parents are in a much higher tax bracket than the kids, and they're helping the kids out anyway. Why not set up a partnership, distribute, income flows just like a partnership would based on ownership. Cash follows the income from a tax perspective, so the kids are taxed on X dollars. They get some money to pay taxes. They didn't need all of it, so they still get to keep some. Overall, the whole family's paying a lower average tax rate. So very worth, but there's other stuff on here where you shouldn't do it because of this, and this. So again, this is a high level when it could be worthwhile. What are your thoughts, Jordan?
Yeah, I think to just summarize, if you're worried about estate taxes or if you're worried about an asset passing on to the next generation where splitting it up isn't necessarily beneficial between all your kids, family living partnerships can be a good option. You're still able to control it while you're alive. It gets it out of your estate at the time you gift it. It does create some additional complications when it comes to your personal taxes and whoever else is involved in the partnership's taxes, which I don't want to understate that. Most people won't understand it at first. It takes normally several sessions, years before people kind of start getting the hang of it. But it is a very powerful tool for avoiding estate taxes and doing some planning in terms of the next generation getting things. You don't want to take, let's say you've got $20 million in cash sitting in the safe. You wouldn't necessarily want to just say, well, I'm just putting cash in this family limited partnership. You could certainly do that, but it's not really an income producing activity. That's what you should kind of be focused on. You can have other assets that aren't necessarily income producing mixed in there, but the majority of them should come from whether it be securities or farmland, how Blake was kind of speaking on.
For sure. Yeah, who should look at them? Family farm, family vacation house, rental property, family business, just high wealth securities. And then, somebody that's really worried about keeping control while gifting assets with these high exemptions.
Yep.
So I'm going to skip how they work. Jordan really just kind of explained how that gets the assets out of the estate. Kids, limited partners would pay usually a lower tax rate, and control is still with the grantor, which in this case would be the parents. I'd rather talk like Jordan said about it takes multiple sessions. Just a true statement. It's not, we deal with this not every day, but many days. We have a lot of clients with family partnerships. We can just in our head know, well, this flows to this trust, which then goes to this kid. It's totally different if you're not used to this. All of a sudden, wait, I get this K1 and I'm filing an extension and I'm getting tax distributions, and it's kind of a whole new world. So if there's $500,000 that's going into this family partnership, and each child's going to get a K1 with $14 on it, probably not worth the overall headache to do it. $5 million, $10 million starts to really make sense. where it's like, okay, it's worth a year or two of headache to then potentially, I mean, depending on where the estate tax goes, save millions of dollars in the future. It all starts to make sense. But if you yourself or you have clients that farmland, family businesses, and then again just high net worth with securities, looking to get that, use the estate exemption now. Makes total, definitely come talk to us about a planning session in general, because again, this might not be the way to go, but a lot of times we start there because it solves a lot of issues. All right, we're going to spend a couple minutes on potential tax changes. We're about 25 minutes in, so nothing's passed at this point. I've had this slide for a webinar or two because would something, it was on the table. Build Back Better, pretty much dead. I don't know if it's fully dead, but it's pretty much dead. So if it hasn't passed, which it hasn't, when will it? Most likely we're looking at this fall before anything kind of gets ramped fully back up. There's a lot of other stuff going on in the world. We're not in Congress, right? It could pop back up tomorrow. But from what we're seeing, it's probably going to be this fall. And when it does, my opinion is I expect the same sort of stuff to be in it. Potential changes to a Roth IRAs, where they limit the backdoor Roth or after-tax contributions or even conversion potential for high income earners. That's a big one where I hope it goes away. I hope the changes go away. I hope it stays like it is. I'm a big fan of Roth. We've seen potential for the tax rates to increase. Top tax rate looking to go up about 2.5, 3 points, but also the brackets would change to where the middle, call it 400 to 600, could see a bigger increase than someone in the 700 to 800 because of the brackets changing. Same thing with capital gains. The proposal was that capital gains, instead of having a preferred rate of 15 or 20%, could go to ordinary income. The last thing that was there before it died was somewhere in the middle, probably a 25% rate for long-term capital gains. But we do see that, something's got to pay for a lot of the stuff that's going on. Probably that's going to be tax rate increases at some point. But at this point, it's not clear on when or if that'll happen. Jordan, you want to talk about the SALT stuff real quick, since you're looking at that?
Sure. So over the last year and a half, it's a state tax issue, but right now there's a cap of $10,000 on any sort of taxes you pay on the federal tax return. So whether that be your real estate taxes, state income taxes, personal property taxes, all that gets capped at $10,000. So if you live in a nice house in California, odds are pretty good that you're capped at $10,000 no matter what. And any state taxes that you're paying on your income, you're getting no benefit out of. Different states have been implementing laws that allow partnerships and S corporations primarily. Most, if not all, do not allow single member LLCs to deduct these state level taxes on the business return, which then therefore allows you to actually deduct them, because then the lower ordinary income passes through to you as a shareholder. So it's an election that takes place. I recommend, if you own a business, if we haven't contacted you already, and you are running at a profit this year, you at least contact us. We can tell you whether or not you're in a state that allows that SALT workaround. It can certainly benefit you. There are some downfalls, just depending on your structure, but it's certainly something to look at. And
on this slide is actually about the feds are talking about changing that SALT cap, which
I'm sorry.
Minimize. No, I know. No, that's what I wanted you to say. So right now it's a big deal. Talk to Jordan, because the SALT, many states have ways where you can deduct more. The feds are talking about changing that. Potentially it makes it to where the election, it was a good for a couple of years, if this changes for a future year. But who knows what actually comes in. I would not bank on the SALT cap going up. I'd rather make the election and pay my state taxes at the business level. We talked about the state tax exemption right now is at a very high level in the $12 million range. Potentially that's going to come down to maybe $3 million, $5 million plus inflation. We've seen it kind of go across the board. I believe that's going to change at some point. It's set to change in the next 3 or 4 years anyway, if nothing happens. But I would think it's going to change before then. So if you're looking to get those assets out of your estate, do it now. Don't wait 3, 4, 5 years, because it could be a significant change in the estate tax exemption. Let's see. All right, last slide here would be, so nothing's happened yet. Talked about potential for Roth IRA changes. At this point, I believe it's going to be, if that changes, it's going to be for 2023. Go ahead and do your backdoor Roths for 22. Do your after-tax conversions. No reason to wait. In my opinion, even if they do somehow retroactively change it, I believe there's going to be a way to undo it. Talk to Jordan about FLPs, trust planning using the high exemption, or just overall tax planning, charitable planning. Just really, I mean, the planning sessions that Jordan and Cruzy are doing, we always start with trusts or your structure, but it could be, let's just talk about what's the 30-year range plan for charitables with my 401k and Roth. Should I convert 500,000 to Roth, have it grow tax-free and go all the way to my kids? Or should I not, because I'm going to just have my entire 401k go to charity? That's a big decision to make. Maybe that's all that comes out of the planning session. Well worth the time. And the last one, use a donor-advised funded charitable lead trust to help the plunge for a big Roth conversion. Again, just get over the fact I'm going to pay a lot of tax. It's going to be worth it, pay the tax. But if you're coupling it with a sizable charitable contribution, that'll help you in the future as well. It helps minimize that tax hit in year one and help you make the jump to do it. Jordan, any final thoughts before we wrap it up?
I think on the Roth conversion, normally the math will make sense, but a lot of that conversation is also, what are you comfortable with? Because it is just as big of a factor as, yes, this will benefit my kids, 30 years from now, but also like your time right now matters and your feelings right now matter and the market matters. So it's definitely worth a more in-depth conversation normally.
100%. So we're wrapping up our FA series next week. Bill and Jordan will be talking about how we work with our small business clients, high net worth clients. If there's any of your clients as FAs that need a higher level of expertise, we'd want you to kind of know how we work. We'd love to talk to them. We're going to do the crash course on July 19th. It's kind of wrapping all 5 webinars of our FA series into 1 hour for those that maybe missed 1 or 2 of them. And then we're also going to have other webinars as we go throughout the year. So look for emails from us. We'd love to see you on any of our future webinars. Obviously, if you have any questions or anything in the meantime, always feel like you can give us a call, send us an email at any point. But yeah, we have a lot of webinars coming up the rest of the year, and we look forward to seeing you there.